Welcome, dear traders. We hope your weekend went well and you are ready to dive into trading. To make it effective and profitable, the InstaForex TV team provides you with the up-to-date news and analytics. Traditionally, our daily reviews begin with the Asia-Pacific region. So, let's start with a recap of the Asian session. Asian stock markets kicked off Monday with losses, retreating following Wall Street benchmarks, which had edged lower on Friday, and today all major US stock indexes have already lost more than 1%. The NASDAQ and the S&P 500 indexes have continued their downward movement, which has been going on for 5 weeks in a row. It's also worth bearing in mind that the Asian region is under pressure from a lockdown in China. The worsening epidemiological situation in the country has already resulted in restrictions for Shanghai's 25 million residents and large-scale testing in Beijing. Against this background, traders expect a slowdown in this region's economic activity. However, this is not the only reason for dismal economic growth prospects. Market participants are also concerned about the events in Europe, Russia's special military operation in Ukraine, and the European Union plans to ban Russian energy. Rising global inflation coupled with a heightened risk of a recession pose a serious threat to global economic growth. On Friday, data on the labor market was released, and thus NONFARM payrolls grew by 428,000 in April, exceeding economists' forecast for 391,000. However, better than expected employment statistics only reinforced investors' worries. The point is that strong employment gains and a more resilient economy allow the US Federal Reserve to take an even more aggressive approach to tamp down inflation than previously expected. As a result, a growing number of market experts believe that the US regulator may raise interest rates by 75 basis points at the June meeting, even though Fed Chairman Jerome Powell has ruled out such a hike. Expectations of an aggressive interest rate hike led to a stronger US dollar as expected. Notably, the dollar index has already gained 9% over the year. Last week, it closed a 5th consecutive weekly advance across the board. As a result, the dollar index, which measures the greenback against a basket of 6 major currencies, reached 104.07, the highest level in 20 years. Well, what to expect this week? Of course, a series of interest rate increases is not the only factor driving the US dollar up. For instance, the yield on a benchmark 10-year US government bonds has climbed a staggering 163 basis points this year and taken the dollar with it. Besides, the greenback is being supported by the risks associated with the situation in Ukraine and China. Against this background, some analysts predict the dollar will rise to the area of 107 in the coming weeks. Anyway, in the Asian session on Monday, the US dollar index continued to edge higher within the daily range of 103.67 and 104.19. At the time of preparing this material, the currency has already advanced to the level of 104.01. Japanese shares are trading mostly lower on Monday following the broadly negative cues from the Wall Street on Friday. Reportedly, Japanese Prime Minister said during an online meeting of G7 leaders that Japan would ban Russian crude oil imports. And this step is rather challenging and costly for the country, which remains heavily reliant on energy imports. However, the world's third largest economy goes for it in principle. Meanwhile, the Japanese currency approached 130.96, its lowest level against the US dollar in nearly 20 years. On Monday, the dollar-yen pair continued to gain value. At the time of preparing material for this video, the quotes have already approached the 131.06 mark. On the daily chart, the yen is likely to see a continued decline within the range limited by the resistance level of 131.35 and the support level of 130.45. Heavy losses in the mining and the tech sectors are dragging the Australian share market down. In addition, investors have already moved over a rate hike by Australia's central bank and its statement about the upcoming series of further increases. The Australian regulator also noted that inflation could be higher than expected and that the jobless rate could sink to the lowest level since 1974. However, these are only prospects. In the meantime, Australian shares are suffering losses in the Chinese markets along with the Aussie. True, China's trade statistics showed that imports remained flat in April, while exports grew by 3.9%. The reading turned out to be slightly above forecasts, which supported the Australian dollar. The Aussie is currently trading at 0.7006, well above its January low of 0.6967. Nevertheless, against this backdrop of the Asian stock market crash, the AUD-USD pair rose by 1% to a 3-month high. Today, the quotes are moving in the daily range of 0.7696 and 0.7075. All the time of preparing material for this video, the pair has already approached the level of 0.6998. Well, that's all for now. Feel free to leave your feedback and thank you for your attention. Stay tuned and watch our next video reviews in a few hours. See you soon.